Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. This is the most important time of the year for retailers, coming off the Black Friday, Cyber Monday sales, and now the run up to Christmas and the post-Christmas sales. But with consumers spending record amounts on Black Friday, some retailers, notably Gerry Harvey, are predicting Christmas will be a little slower this year. So what's it all mean for investors in the sector? I wanted to look at some of the household names across both consumer staples and discretionary, from Coles and Woolies to places like Harvey Norman and Breville. Remember, this is general information only, and you should seek professional advice before making any investment decision. Ben Gilbert is the head of Australian research at Jarden, leading their research team and consumer sector coverage. Ben, welcome back to Fear and Greed.
Thank you very much for having me.
So where we are today, how big was Black Friday and Cyber Monday for the retailers?
Look, it was big, and I think it was better than feared. We've got a bunch of data that's rolling in, from web traffic to credit card data to anecdotes, and we've spoken to 20 plus companies in the last couple of weeks. And I think generally speaking, it was better than feared. Saw a little bit of growth. There were some standout categories like electronics and gifting, but there were also some softer categories like apparel. And I think, to your point and question in the opening, that the $1 million question now is, what does this mean for Christmas? And I think the fear is that there's been a lot of pull forward of Christmas spending. So it's going to be very interesting next couple of weeks.
We don't really have history to guide us too much. I mean, Black Friday, Cyber Monday's been around for a couple of years, but it's not like we've got a long series here to kind of get a feel for what to expect. Is that right?
Yeah, it's a relatively new phenomenon. We've sort of borrowed or taken this from the US. And I think what we've found is that it's got bigger and bigger every year. And what it means is it creates some challenges with forecasting. It also creates some challenges in terms of identifying where we're at and how the consumers are positioned. What I think we're finding now is that people are starting the promotions earlier. And it's almost as if we've got a cyber month, because what you saw is a lot of discounting that started at the beginning of November and carried right through to the cyber weekend.
Okay, so moving away from specific sales events, the economy itself, last week's economic growth and GDP figures certainly show that household spending is struggling. Retail sales have struggled a bit. High interest rates, high petrol prices, cost of living, et cetera, et cetera. We've got low consumer confidence. How much is that playing into all this?
Well, look, it's not easy out there, and I think if you look at it, while the retail sales are still growing, if you look at it on a per capita basis, we are technically in a bit of a per capita consumer recession. But what's really carrying us through at the moment is record levels of population growth, particularly for working age population, and that's running upwards of 2.8%. If you look at confidence, though, it's at recessionary levels. If you look at how people are telling us in terms of financial hardship, et cetera, from the surveys, it's definitely pretty challenging, and you're seeing big tick-ups. If you look at spending by demographic, you're seeing some pretty weak numbers for the younger demo who's mortgaged and might not be able to go on the benefit from all the rising rates now. But if you look at the boomers and the older population, they're spending. They're going on holidays or ski holidays, as we call them, spending kids' inheritance.
I like them.
And what that's meaning is we've got a bit of a haves and the have-nots in retail at the moment.
Okay, so can we just go through some stocks? Let's think of the staples first, and I actually want to talk about the discretionary more than the staples. I mean, the Woolies, the Coles of the world. What's the outlook for them over the next 12 months or so?
Yeah, look, in theory, in this sort of environment, supermarkets do well because people don't eat out as much. They come and eat at home. They trade down into private label, which is typically higher margin. And if you've got a good value proposition, you can do well. What we are finding, though, is that we've got a lot of cost pressures in retail, and that is causing some challenges. But look, ultimately, I think Coles and Woolworths should be pretty well positioned over the next 6 to 12 months. We've got a preference for Woolworths in the space. We like what they're doing around data and loyalty. But ultimately, look, I think the outlook in the near term for the supermarkets is looking pretty positive.
Stay with me, Ben. We'll be back in a minute. I'm speaking to Ben Gilbert, Head of Australian Research at Jarden. Okay, what about some of the consumer discretionary stocks? I know you cover, everything from like corporate travel management, which isn't really in the retail space, through to Domino's and Harvey Norman, JB Hi-Fi, etc. What about some of those electronic retailers? You said they had a good Black Friday, Cyber Monday, so Harvey Norman, JB Hi-Fi in that crowd. What's the outlook for them?
Yeah, it's an interesting one because I think if you look across the market at the moment, they're probably consensus underweights or don't touch, because you're seeing deflation coming through in the categories. You've got discounting, you've got the likes of Amazon that's growing at the rate of knots, but they're continuing to trade well. And I think JB Hi-Fi in particular is winning share. they're doing some good things around targeted promotions, and they've just got an offer that resonates with the consumer. So while we're generally cautious on the name, they're continuing to probably trade better than we might have all thought. But again, I think the million-dollar question is being a discretionary retailer, how much of the strength that the category and most likely JB saw over the cyber weekend was a pull forward.
Yeah.
And so Christmas is obviously a very important time. And if it was a pull forward and there's a lot of gifting, it could create some risk around that all-important December Boxing Day trading period.
What about stocks, the liquor stocks? Endeavour Group's an obvious one. Treasury Wine Estates is another. I would have thought this was a pretty good period for them. What do you think of those guys?
Yeah, look, we like both of them at the moment. They're two very different stories. I think Treasury has definitely surprised, maybe even shocked a few people with the size and the materiality of the acquisition they've made in the US recently. The focus has really been around China and potentially the tariff easing, which provides a pretty significant opportunity. And we've generally been pretty positive in terms of that opportunity, what it drives in terms of both earnings and also just tightening up supply demand for Penfolds. So look, if it does open, you're potentially going to see some prices on your Penfolds product rise, but it will be pretty favourable for earnings. And the China benefit is not in their guidance. So we still like Treasury.
Sorry, just before we leave Treasury, and they've still got, though, this purchase they've done in the US. There's an integration risk in that one, though?
Yeah, look, potentially. There's always integration risk with acquisitions, but I do think they've done a lot of due diligence, as you would expect and hope, around that. There are definitely some synergies as well from production. There's some synergies in terms of they're going to be one of the biggest, if not the biggest, premium or luxury wine brand or company in the US. So it provides scale with their customers, which is always a positive. But look, I think that the challenge and the focus for this is it's been on some pretty exponential growth the last couple of years. And the million-dollar question is can they maintain that, and can they continue to expand it? And as we all know with brands, is that you can only stretch brands so far. And the question is how much can you continue to scale this brand up? But by all accounts, and look, to be honest, I didn't know it before they bought it, it's very well regarded, it's selling very well, and it's resonating very well with the US customer base.
Okay, Endeavour Group, totally different kettle, a lot of boardroom shenanigans. Maybe you wouldn't use that word, Ben Gilbert from Jarden, but I'm going to use it. A lot of carry on there. What about Endeavour?
Look, I think Endeavour's got a very, very strong set of brands within its business. I think if all of us sit around and say, well, what are probably the two most powerful brands in Australia, or two of the strongest brands, I'd be surprised if most people in that mix we didn't have Dan Murphy's and Bunnings. Dan Murphy's is obviously part of the Endeavour stable. It's a powerhouse in the liquor space. And look, the liquor market's been challenged. People are generally drinking less, but drinking more premium. But I do think, look, in this environment, as people are seeking value, they're looking for better deals. They've obviously got a pretty compelling price promise that they put out there. It should trade relatively well, albeit, as I said, the liquor market has been challenged. And look, I think probably one of the more exciting opportunities that's emerging now is in their hotels division. They've recently had an investor day, and they've talked to aspirations to generate another $150 million of EBIT out of that by fiscal 28. That's a big number, and that's well ahead of where the market was thinking. And obviously, what you find with companies, if they can surprise positively on earnings, often the share price will follow. So I think this is the big test or question that's facing, or one of them that's facing Endeavour at the moment, is can they hit that number? Can they lift the returns within the business? And if they can, I think the business is set to re-rate and do quite well.
Earlier on in this discussion, you talked about apparel being a bit soft in the recent sales. I know you cover, I think, Accent Group and Premier Investments, Ben.
Yeah, look, it's interesting with fashion because the data's telling us it was softer, but you look at Premier, who came out with an update the other day, and Premier being the owners of brands such as Peter Alexander and Smiggle and Just Jeans and JJ's, to name a few, they had a very strong result. They reported record sales, and they've actually came through and upgraded their numbers with the market. And what they've said is it was going to be about 10% higher than what the market was thinking. Share price reacted accordingly, obviously going up. And I think it's just a testament to how well this business is run. The other thing I think that's interesting with something like Premier at the moment is they're exploring a strategic review. Now, at the moment, they all fall under the Premier brand. But what's the market speculating and we've written about is, are they going to split these brands up? Could we see Smiggle trade as a separately listed entity? Could we see Peter Alexander trade as a separate listed entity? Will these expand aggressively offshore? Smiggle already is offshore, but a lot of opportunities. So there's a lot happening, and I think a lot to like with Premier at the moment. And I think, as I said at the start, it's a testament to how well the business is run, the fact that they can continue taking share when the market is still pretty challenged.
But I have to ask about Domino's. It's like one of my all-time favourite stocks. I did do work for them many years ago, so I have to put that out there. But I've known the chair quite well over the years and the CEO and things like that. But it has been like a roller coaster ride for Domino's.
It has, and I think more recently it's probably putting it a nice way to sort of call it a roller coaster. They've definitely had some challenges, and I think they've been pretty frank in coming forward with those and admitting to those challenges. Look, I think the thing with Domino's now is that they're starting to really focus around the customer again. Now, they've never lost sight of the customer, but they did some things like putting delivery surcharges on, probably pushing price a little bit too much, which they've all conceded, and they're now really focusing and getting back to the core and being the true value proposition in QSR. And now when we're all sitting around and we're seeing our mortgages go up week in, week out and pay more for our groceries, if you want to treat your family or celebrate, you can go and spend $30, $35 and you can get a couple of pizzas, garlic bread and a Coke through them or a Pepsi. And it's obviously a pretty attractive proposition. So look, we think they're doing a much better job. They're also very focused on costs. There's a pretty significant cost out program going across the business at the moment. And similarly, they're also very focused on returns. And when companies are really focused on driving improving returns, generating more cash, again, the more cash you've got as a business, the more cash you generate, the more it's worth. So if they can execute and they've got some guidance out there, I think it's a pretty positive story. And we can see the share price is a long way off where it has been in the past. But it's not to say it can't get back there again through successful execution and continuing to expand in markets such as Germany, Japan and France.
I'm loving this, just running through these stocks. I'm going to stop now, but I do have to have one more sector, kind of retail. All the travel guys, Corporate Travel, Flight Centre, Hello World, Webjet, I suppose is in that lot. What's the outlook for that sector?
Yeah, look, travel's an interesting one because if you're sitting at the moment looking at all the economic data, you're thinking, well, geez, this doesn't look good. I don't want to be exposed to anything that's got a consumer tilt or discretionary. But as we said at the start, you've got the real exposure to the boomers and the older demographic that are typically net cash or getting benefits from higher rates. And as a consequence, what are they doing? They're traveling. And so if you look at the likes of Flight Centre, Hello World, they're all performing pretty strongly still at the moment, had some positive updates, and we're pretty positive on the sector as a whole. Webjet is a little bit different. Webjet, it's about Webbeds, which is their bed bank. And this is a business that I think is going to be a global player. It already is. It's got a pretty significant and attractive opportunity. And I think it's one that can sort of drive this stock to re-rate that's not well understood or appreciated by the market.
I'm going to be very ignorant. Webbed. What is it?
It's a bed bank. So you think if you're a hotel, you'll put your inventory, being your rooms, into a centralized player, and they'll then go out and distribute that. They'll try to optimize pricing. They'll try to get you to the right customers. So it's an interesting phenomenon, and they're sort of a top 3 player globally in that space now and growing strongly.
Something to think about. Ben, thank you for talking to Fear and Greed.
No problem at all. Thanks for having me.
That was Ben Gilbert, Head of Australian Research at Jarden. This is the Fear and Greed Business Interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.